Good day, everybody. This is OptionProfessor.com for the weekly market update for February 8th, 2019. Again, by introduction, I'm Jim Kinney, and I will be the person speaking here today. A little background on myself. I'm a graduate of Boston College, and I've been in the investment arena here for many decades. I've given I've done hundreds and hundreds of seminars to thousands and thousands of people nationwide in my career, understanding and using the option market as either a hedge to protect against market declines, as a cash flow income producing strategy, and also as a limited risk speculation. So I am very informed in this area. And I do remind everyone that past performance is not necessarily indicative of future results. And always, because short-term trading and option trading involves substantial risk, to do consult with your clearing firm and your broker, and also your good common sense before you enter into any type of risk investment. Okay, now, I've been talking about a bunch of things here at the podcast. Again, if you are coming in for the first time, welcome. And if you have told friends or associate about the podcast, that's good as well. Don't forget, all you need to do is go to OptionProfessor.com to get the link. So let them know that. And any question you have on anything that I cover, shoot me an email at optionprofessor@gmail.com. OptionProfessor.com. Okay, as I've been saying here, just as a review, the stock market had a big dump in December. Again, when we were up at 2,900 and Amazon was up at 2,000, I was explaining to people that the market was way above its 200-day moving average, and the probabilities and likelihood of a move back to the average, in my view, was very high. So up at those higher levels, I did suggest people investigate married puts. That's where you have put options against your positions. So if it goes in the tank, you've got insurance against the big drop. The other thing I was suggesting looking into was the collar strategy. That's where you sell an out-of-the-money call, you take the premium in, and you buy a put with the call money you just received. If the market stays in the window you created, one offsets the other. If the market goes into the toilet like it did, you've got good protection, and it was paid for by a worthless call that you sold above the market. Good strategy, good timing, but you got to know what you're doing. Again, that's why I gave you the email account that you can shoot an email over if you have any questions or you want to talk to me directly. Okay, now more recently, we had a big run up from December, right? January's up like 9 or 10%. Now this market, again, earnings were supposed to be up as far as October is concerned, 10 to 12%, maybe 15% in some estimates. And now they've cut them all the way back to 5% growth. So what are we saying here? If earnings are drying up or at least slowing down quite a bit, again, that's a problem for high multiples, meaning for every earning the stock gets, every dollar of earnings, there's a ratio, a PE ratio. When Amazon was at 2,000, the darn PE ratio is way above 100. Look at it today. It's not there anymore because people are not as willing to pay as much for $1 of earnings. Now, earnings is the key to the market. That's what drives it, right? If you don't have earnings, that means you don't have profits, right? So what we're saying here now is that on the about 300 S&P companies that have announced so far, 61% have been beating on the bottom line, 72% on the revenue side. So basically, we're getting some reasonably good numbers, but they lowered the bar, and that's why these things are beating. Energy and healthcare have been beating on the revenue side, and on the bottom line, energy and tech has been beating as well. I'm going to get into that situation in a minute. But what I did tell everybody is when we got this rally, the market seemed like it was destined to go to the 200-day moving average. Why do I like moving averages? I've been doing this for decades because moving averages don't lie. They're based on price and they're based on time. That's not an opinion. That's a fact, price and time. Now, they're not going to be telling you exactly what the future holds, but it is going to, shall we say, smooth out the rough edges of the volatility of the prices. Now, you can see we're back in the tank here to 26.83. Let's take a look at where the market peaked, right around the 27.50 area, and look where the 200-day average is, 27.42. So you can see that the market went right up towards that average. In fact, I had a friend who said, I'm going to buy every dip after December. I'm going to buy every dip until it gets to the 200-day. And that was brilliant because every dip in the month of January was a buy opportunity. But now we've hit the 200-day average, and it's my view, and it was my view last week if you tuned in, that you should be looking at defensive tactics at 2750 area. That means what? Go back to your married put concept and see if it makes sense. Go back to your collar strategy and see if it makes sense. So then when it goes back in the tank here, we've lost 50 points on the S&P, or 60 maybe, right? Those would have been offset to a degree at least by the hedging tactic. But if you don't know what you're doing, and certainly, if you're trading on your own and you're expecting these companies that just service your bets to call you up and give you ideas, it's not going to happen. You're on your own when you trade on your own. So you better know what you're doing. And again, one thing you got to know what to do is protect your equity against market declines. And that's exactly what these tactics I'm talking about are all about. Had they come in handy up at 2,900 on the S&P and 2,000 on Amazon? I think so. How about 225 on Apple? Would have been a good thing to hedge up there, right? Well, this rebound rally may have ended on that move to 2750. We'll see. If we can get above 2750, 2800, which I think is the big resistance area, then I will start turning into more bullish if we can get above that level and maintain. Up until that point, this was a bear market rally. And again, everyone got sucked in January because, again, that's when the pension plan and the 401k and the people are putting in their IRA money, and they all dumped it back in. And obviously, when you drop from 2,900 on the S&P to 2,350, that's a lot of selling. So obviously, when all that buying comes in January and all that selling has already been done, who's going to sell down at 2350? If you wanted to sell, you already had. So you got no sellers and you got all these people buying. What do you think the guy who makes the market's going to do? He's going to raise the offer and make you pay through the nose. And that's what you just did. You just paid through the nose. Now, the question is will I be corrected by the market getting above 2750 and 2800? Only time will tell. Today, it certainly doesn't happen. Now, what could be happening down the pike that would let you into a situation where the whole landscape could change? Well, the Fed paused and the market is still not exactly that stable. So the Fed's on pause. So you can forget about the Fed, being a factor. And then what's the next thing? China deal? Come on. China's got 2025 on their mind, and these people deal in centuries. They don't deal in 6 months. Okay. So what's going to probably happen in my view? Again, these are all my opinions and my views today. My view is they're going to give them what? They're going to buy some of the gas. They're going to buy some of the soybeans. That's a no-brainer. They're going to go on internet. They're going to go with intellectual property. Yeah. Well, if they agree to it, they're probably not going to adhere to it. Why? Because that's a big part of 2025. Getting the technology to put them in a leadership role. Okay, so they'll probably get some kind of a deal, so the president and the administration can say they got something done, right? But if you tear back the onion and you look at the middle, it might not be much there. Same thing with the situation with Mexico and Canada. Much ado about nothing at the end of the day. So, and again, the North Korea thing, that guy's going to give up his weapons when pigs fly. And the last thing I checked, pigs don't have wings. So, that's my feeling. That's my opinion. I kind of like to live in the real world. And I just don't see realistically these guys rolling over and playing dead for a president who may not be here in 18 months or whenever the election is at the end of 2020, right? So we're already into 2019. These guys are not dealing in months and months. They're dealing in years and years and decades, right? Okay. All right. That's just my view on that. So anyway, what's the story? The story is we had a rebound rally. We went up to the resistance of the 200-day average. We rolled over. The VIX went down to a very low area. Let me show you the VIX. And the VIX went down to the 15 area, and now we're at the 17. So the VIX is totally turned to the upside. It's up 623 now. And again, if the VIX can let me tell you about the VIX again, for those of you who are just tuning in for the first time. The VIX between 25 and above is in the red zone. What does the red zone mean? When you get above 25, look at it last February. You see, that's when the market collapses, when the VIX gets above 25, right? When it gets above 25 at the end of December. That's when you got the collapse going, okay? Now, when you're trading between 15 and 20, the market generally is fairly stable. 15 and 20, fairly stable. You get above 20, you're going to be dropping. You're going to be dropping, okay? You get under 15, which we haven't done since last October. Coincidentally, that's when the market rolled over, right? Right. So if you can't get about under 15 on the VIX, I don't think you can be in a bull market. That's my view. That's my opinion. They're the numbers. They look like they coincide with what I'm talking about. Can you see as the market was rising that the VIX was well under 15, right? Okay. And then once it broke, bam, you haven't seen 15 until recently. And that's why this move to 2750 might be it. The VIX is 15. That's about the low. 2750, 200-day average. A lot of things coinciding. Now, again, if you get above 2750, above 2800, you got to change your tune. I'll tell you, you're dealing in a moving, living organism with the stock market. Things change. And if you want to be, what the Lee Iacocca decades has said, you want to stand still in the auto business, you're going to get run over. Well, that's the same thing with this business. You stand still with your opinions too long and you don't recognize things have changed, you're going to get run over. Right now, you're not going to run me over until you can get above 2750 to 2800 and stay there. Make it stick. Okay, not just we have a deal with China, it spikes up there and everyone gets excited and the smart guys sell into it. And the next thing you know, we're right back down again. That's not what I'm looking for. I'm looking for a move above 2750 to 2800, and then I'm looking for it to stick. And a one thing event like a China mouthpiece deal is not going to be enough to make it stick, I don't think. So that's my view. That's my opinion. And that's what I'd be doing. And that's what I have been suggesting people investigate as well. Okay. Let's see what else is going on in the news here. Again, I did mention the earnings. And again, the main thing that I see here is they're looking for a 5% growth rate. Again, the comparisons in the first quarter are tough because 2018 was super. Second quarter comparison should be tough. Again, very good quarter. Third quarter earnings comparison, very tough because, again, a good quarter. Fourth quarter last year, we know it stunk, right? Because we collapsed in the price. So by Q4 of this year, the comparison should be quite a bit easier. And then that might be the turn a little bit in the earnings picture, providing we don't have a significant slowdown overseas. Now, let's talk about overseas. Okay. China's still growing. And they're still looking for a 6 handle on their growth. So there's not like it's collapsing over there, but it's just not accelerating. And when everyone bet on it accelerating and it doesn't accelerate, that's what makes it come back in. Now, I'm going to go over a couple of China stocks that I would look at right now and see what they look like, because I've been mentioning it to you on this broadcast. Let's talk about that right now. BABA, 130 it hit. That's when I was bringing it to your attention. Let's see what it's doing today. 166. Okay. So you are getting a turn. You see the low is 129. That's the neighborhood that I started showing it to you a few podcasts back. Why? Because the thing came down from 210 and it's not going to go to zero. Okay. This is a company that's making money. Okay. And bottom line, it's a company that has very, very good prospects demographically. 40% savings rate in Asia. That's a big, ours is 20%. So there's and the middle class is supposed to be exploding in that area in Asia. So you got a big middle class coming and they save a lot. That means they can spend a lot. And that's where BABA comes in. Now, you've got a double bottom at 130. You went up to 170. Let's take a look at the 200-day moving average and the 50-day and see if this could just be a spike up and then a comeback down, or if there could be a legitimate turn. Let's see if the 50-day has crossed the 200-day. And it hasn't. So again, this is where you'd have to be careful with BABA because, again, you are at 168 on the 200-day and you're at 165 on the price. So this is not a neighborhood to get jumping in. This is a neighborhood to see if it can stabilize between 200 and 150 so that these moving averages can turn around. When these moving averages turn around, the 50 above the 200-day, then I think you might have something going on. Otherwise, it's just like the stock market. It had a bear market run, and it could fade right back down. Now, with regards to being away from the moving average and why I watch them, when we were down at 130 and we're up at, say, 170 on the 200-day average, right? You take that 130 away from 170 and you get $40. You divide it into 170 and you get 23% underneath the 200-day. My view, my opinion, when you get above or below the 200-day average by 20, 30, 40%, you're in a neighborhood where it's going to gravitate back towards what I consider to be the mean, which is the 200-day. And that's exactly what we did here as well. We went down 25% almost underneath the 200-day. And what has Alibaba done? It's gravitated back towards the mean. What's the mean? 168. So if you're at the mean here, maybe it'll pop through it a little bit to get people stopped out who are shorting and stopping above 170. But if it can't stick above 170, it's got a good shot of sliding back down. And again, if there's no China deal, maybe that would be the catalyst for a slide down. But on a longer term basis, that double bottom at 130 looks like a base to me right now. So if it does pull back and it does hold its water, I think you're in a situation where the Chinese stock market might be worth a look because it's discounted substantially. Europe, not as much. Okay. Why? Because Italy's in a stagnating situation and they're now paying 370 on their 10-year, which is ridiculous in Europe because the bunds are trading at like a 0.5%. So obviously something's going on in Italy. I had an opportunity to go to Sicily a year ago to play some golf. And when I was over there, everybody was complaining that they still use the euro because it makes them very expensive. This happens a lot. In Haiti, they were using a French currency that was 2-to-1 to the dollar. Now, when you're in a third world country and it's 2-to-1 of the dollar, they're using too strong of a currency. Same thing with Italy down in Sicily. You know, the north is Milan. They're kicking butt. But down south, it's a rough racket for Italy. And so basically, you know, they're in a situation where they'd like to go back to the lira so everybody has money to spend so they can go out and buy some restaurant food and stuff like that. Anyway, you can see that Europe, they just announced Germany's numbers are slowing down. And you can see this is in a defined downtrend. But again, I'll bet you it had a move back towards the 200-day. Let's take a look. Went down to 32. And it recently jumped up towards 35, 36. And you can see the turn to 200 days, 37. So went up towards the 200-day and came right back down again. So again, Europe doesn't look very good. Now, what does that mean for U.S. stocks? Well, let me tell you, on the big stocks over there, 40% of their revenue, according to what I understand, comes from overseas. Well, if 40% of your revenue comes from overseas and you can see Asia's slowed down and you can see Europe slowed down, well, what the heck do you think earnings are going to do? Go through the roof? Probably not. And if you look at real estate in our country, it definitely looks like it's quieting down. I just saw a thing about the greater New York area, and a lot of people tried to sell their house. Why? Because they came up with that tax bill, and now you can't deduct state income tax, state taxes or something like that, or at least there's been an adjustment on it, and people are trying to go to Florida. Right? Get out of that cold weather, get out of that high tax stuff, and get down to Florida. That's what a lot of people are trying to do. Now, with all that supply that hit the market, there was no takers. And that's going to be a problem because oversupply is a problem in real estate. I also saw that in 27 zip codes, many of the loans on the real estate are 125% of the value of the property. That doesn't sound good to me. That sounds a little bit 2008 to me. So real estate could be a wild card as well. And again, let's turn towards one other thing here for you, which is the Treasury market. Okay. They're on pause. What's going to take them off pause? I'll tell you what could take them off pause is if we get an inflationary situation happening. Stagflation, stagnating economy, inflating prices. This quarter here, I have been a believer that companies are going to try to raise prices to offset slower sales. And, you know, I see a lot of price raising going on. Now, if you're ever going to try to raise prices, you're going to do it when 4% unemployment, right? You're not going to wait for unemployment to start spiking and then try to raise prices. I mean, that'd be stupid, right? People have jobs now. They have money. Maybe you could slip in a 10% increase in prices. I know they did that at some of the things I look around at when I go out to eat or when I go out and buy things. Even at places like Walmart, you can see prices have risen up at least 10%. When those numbers, and if those numbers start hitting the tape, because again, aggregate wages are increasing at about 5.5%, I've been told. So a 5.5% aggregate wage inflation, nominal 3.2, is well above the 2% rate of the Fed funds. So obviously, if there is an inflation wild card this year, two things would happen. You're going to see a reversal in this Treasury note market, and it'll get out of this 2.6 area. And once it gets above 2.8 and 3%, then it will be back on the bicycle. Not happening now, but keep an eye out for that. And if that happens, okay, you're going to find the bond market back in trouble, along with maybe the loan market as well. Now, one other thing here, a lot of people have, because of this drop in yield, people are running into junk bonds again. You know, junk bonds have gone nuts again. Let me show you a junk bond thing real quick. And some of the covenants, meaning the coverage on some of these loans, is not very good. These are highly leveraged companies. Look at that. That could be a thing to sell into as well, Because why? These are junk bonds, and they were going in the tank, right? You can see this the chart right there. Okay, let me bring it down here so you can see it. Okay, big rally, a big drop, right? 86 down to 80. Now it jumped all the way back to 86. That's a pretty big jump. And now they're issuing it again while they can get it off the shelf. Look at that gap at 81. You think it's coming back down there? If the stock market drops, it's coming back down there, in my view. Okay, big volume. You see the volume here at the low? Obviously, that's all the sellers coming out. So when the news got better in January, all those sellers, look at that volume. Everyone's out. And so when people want to come in and there's no sellers because look, everybody got out during the drop, then you've got order imbalance and the buyers are way bigger than the sellers and they raise the offer. They let you get in at 85. Everybody in, everybody's in. Now they can take it back down. Look at the volume on the advance. Very low compared to the one on the sell-off, right? Right. Okay, so beware of junk bonds up here. It looks like people got a little ahead of their skis. Now, what else do I have for you? Let's go through a couple of things. Again, the US dollar. If the Fed is paused, the US dollar could have trouble unless it's a situation where the rest of the world is so terrible that people run to the dollar as a safe haven. Maybe you don't want to be in the euro if the euro's going to go in the tank. Maybe you don't want to be in the Australian, the New Zealand dollar. Maybe England with Brexit, you don't want to be hanging with a currency that used to be over 200 that's now down at 120, 130, right? Maybe that's the case. If that's the case, then these earnings are really going to have trouble because 40% coming from overseas with a strong dollar is not what you want to be. My belief is that one of the reasons that Powell paused was because he'd like the dollar to go back down to help these multinationals. If in fact that's the reason, then this rally we just saw in the dollar should end here soon. And if we get under 95, you can see that you could be yelling out timber if it gets under 95. 95 and then 94, not a lot of support underneath. So watch the US dollar. If it breaks 95 and 94, I think then you can say the trend has changed to the downside. Let's look at the moving averages to see if they're telling us anything. Okay, there you go. The moving averages are 92 and 94. They're inverted. Okay. Now we've rallied here above both, but these things have inverted to the downside. That's not good technical picture. That's why I say you get underneath 95 and 94 and you're already inverted on the 50 and the 200 day. This thing is going to be going down if that weakness does appear. Now, conversely, again, you got to be flexible. If this thing maintains above the 94.50, that 200-day average is going to grow and get back above 94, and then you're in a bull market, and maybe you're going to 100 on the dollar index. That's why right here it's hard to make a big call on it because it is in the support zone around 92, 94, and it's trading 96. So keep an eye on it. Too early to call the death of it. I said at 98, it looked like it would roll over, and it started, but now it's coming back up because of the weakness internationally, and our rates are relatively high basis everyone else's rates. If you see 95, 94 get taken out on the dollar index, I think that would be very good for gold. Now, gold, because the dollar did weaken, did have a little bit of a pop, but it is stalling out here a little bit. But this is something that I brought to your attention, and it's been a pretty good moneymaker. Down at 17.18, okay, I could see it starting to turn. So I brought it to your attention, 17, 18. I said if we can get above 20, it would be very positive. Can you see? Went above 20, came back down and tested it. 20 is a big number on this thing now. Then we popped. I said we get above 22, it would be good. We got above 22 to 23. Now it's stable at 22. This thing, and there's a gap there. Maybe it's going to come down and fill that gap because if the dollar remains firm, it could weigh on this thing. Gold itself has not been able to get above 1400. If it gets above 1400, and if the US dollar breaks 94, I think there could be a big story in the second half of the year. And of course, if they bring an inflation story into the picture, nobody thinks inflation's coming back. When nobody thinks something's going to happen, that's when it can be dangerous. So my call on this is the gold market looks like it may have made a turn, but it's only going to follow through if we get that dollar to drop and these inflationary numbers that I think may hit the market in the first half of the year come to pass. Otherwise, it could go right back into the fade mode because a strong dollar and no inflation, that's not what gold wants to hear. The reason it's made the turn, inflation on the wages have picked up and the dollar rolled over from 98 to 95 area. And those are things that would make people that are short the market in gold cover and get long. Again, 20, big number for this particular gold miners thing. All right. All right. So that gives you a little bit of an insight into there. A lot of people also like the oil situation. And uh, let's look at XLF. This is a sector that's supposed to benefit here. XLF. That's the oil ETF spider from, excuse me, for the ETF for the financial sector. This is and this is another reason why the market, I'll get to energy in a second. The financials are turning over to the downside, as you can see, and that's not good. Big rally, right? You had a big volume down to 22. Then all of a sudden, people thought, get back into the banks. They start buying the story. They started buying this story last year up at 30, 35, and look where it dropped them down to. So now we had a big bear market rally. Can you see it stop where those lows are? That's not a good sign. So you want to get above 26 if you want to be bullish on these financials. Okay. But the financials have rolled over, and that's not a good situation. Get back above 26. It could be a good situation there. All right. And then the energy and the healthcare. Those are the other two I wanted to talk to you about real quick. Okay. XLE is the energy ETF. And as you can see, similar to the banks, big rally, and then it pulled back down. Okay. So again, 55 is the low, and it came all the way down from almost 80. So that's a big drop. Where's the 200-day and the other? Let's look at that real quick. Gives you some lines in the sand to work with. 60 and 70. So as you can see, it's a bear market, but it's just this market that may be turning because it got so oversold. I mean, you went down to like what did you go down to here? 55, and again, the moving average on the 200 days at 70. So that's a 25, $15 drop. Again, divided into your 70. There's your 20% underneath the 200-day. Again, another example of when you get way underneath the 200-day, you want to look for strategies that might get the market to bounce back up. That's a general idea, not specific every case. But again, another example of when you get way oversold or overbought, you got to start looking at the other side of the trade. Or hedging. You don't want to get out of a position. Put a little insurance on. You got insurance on your house, right? You got insurance on your car. You got insurance on your life. You got insurance on, your diamond ring. Put some insurance sometimes on your portfolio. I think you'd be happy you did. Okay, one last area was the healthcare, okay? And we're going to look at the Vanguard healthcare thing here, and that is going to be VHT. Obviously, there's many ETFs out there. I'm just showing you one. All right, healthcare. You can see another big rally came way down. Again, earnings have been very good in healthcare because obviously you've been to the doctor lately. You know why. Big volume drop off, though. You look at the volume during this drop. You see that volume? That means everyone's getting out. So if people change their tune like they did in January, there's going to be a lot of buying into healthcare. It's a staple, right? And what? There's no sellers. But look how lousy the volume is on the rally. That's why you got to be concerned about the rally. I told you 2750 last week, the week before. That's where we got to. Has it rolled over? Yes. Was that the place to start thinking about hedging? Yes. Again, I encourage you to email me at OptionProfessor@gmail.com if you'd like to speak to me directly or you'd like a question answered. I'm more than happy to help. That's all I got for you today, and certainly I hope gave you quite a bit to chew on. I will be back on Friday the 15th for another episode of this podcast and weekly update. Until then, again, shoot me an email and good luck, and hopefully all your trades will at least be stable and hopefully profitable. Thanks a lot, everybody. Back to you next Friday.